Thanks everyone for coming. Hopefully you're not sleepy after the lunch. So we're going to start a conversation here. Everyone in the panel invests in companies at a pretty early stage, but it's an even bigger leap of faith to work out valuations for an angel investor like you, Anna. Can you talk a little bit about how you go about valuing investments and how it might be different from later stage investors? And David and Xing, please jump in with how you guys value the company.
Yeah. Well, to be honest, it's actually quite arbitrary because you don't have any numbers. Most of the time, a lot of our successful investments, you know, they just have, it's a person walking here with an idea. They have no numbers to go by. Can't do any revenue multiples. So a lot of it is based on comps, historical comps and current market comps, as well as how much money they need. So I think historically we've thought about how much money do you need for the next year. Usually in China, that's about, for a team of 10, the cost to run a company is about $30,000 per month. So, you know, you can, with $500,000, you can get pretty far, and we usually take between 10 to 20% equity stake. So that's kind of working backwards when you have sort of nothing. But at the same time, besides comps, I think it's really the founder's bargaining power. So who are you? What kind of job are you forsaking? You know, how old are you? Are you sort of in your early 20s? Are you someone who worked at Google, you know, for many years and you're giving up $2 million of salary per year? Then that sort of valuation might be a little bit different. And I think our typical valuation range, I think 99% of the time will range from 1 million to about 10 million. But then there are some outlier situations where even last week we had to go up to 50 million. Earlier this year we had something at 80 million just for the first round pre-anything, which is ridiculous. And I can talk about those and why, you know, why people are doing that. But most of the time I would say single digits.
How about you guys? How do you go about, you know, valuing the companies when you're analyzing investments?
Well, valuation is really a function of the demand and the team, and certainly market conditions. And as Anna said, you know, the arbitrariness kicks in when, you know, when a company has 3 term sheets, the price is going to go up. When it has 0 term sheet, the price is going to stay flat or down. If you actually look at statistics, right? I mean, seed stage goes from, you know, 1 to 15 million pre-money valuation. Series A is typically 20 to 50. Series B is 50 and above, so on and so forth. But just to give you a range, right? For example, when we did the first round of Kakao Talk in Korea, Kakao Talk is the, you know, WeChat, Weixin of Korea. You know, it was 100 million pre. Why? Because the founder was the former co-founder of Naver, which is the largest Korean company, internet company. And so he had the experience and the knowledge of how to start a company. Now that's an extreme, but it happens. Conversely, if you are, you know, 24 years old, never did a company, first time CEO, you know, you're going to probably end up with, you know, 1 to 10 million pre-money valuation. And so, you know, I think the lesson here is, you know, getting the best set of team early is worth it. Talk to investors early and try to sync up the investors so you can get the term sheets around the same time. The minute you have 1 or 2 offers, that's when you can really, you know, get the higher valuation. But, you know, every firm has a limit, and I would say right now the environment is that, you know, VCs, you know, since the slowdown over the last year, VCs definitely take a little bit more time, and they're also willing to walk away. So, you know, I think the entrepreneur still has the leverage, but I think it's a little weaker than it was the last, you know, compared to a year ago.
Right, I think the valuation, I mean, both David and Anna talked about what companies can do, what the founders can do, but there's also certain elements that are external to you that you kind of just have to accept that, right? The macro environment, for example, right now the environment is, as David alluded to, investors are becoming more cautious, are becoming more selective, and are more less willing to go with the hefty valuations. So that if you are working against that kind of a macro environment, what you could do is you focus on your internal things, right? You have a good team, you can articulate your story very, very well, you practice a lot, and you try to meet as many investors as possible. If you have, it's a demand and supply market dynamics. So the more you can get people interested in you, get more term sheets on your hands, then perhaps you can turn the bargaining position in the other way around a little bit. But still, the macro environment does play a factor in the valuation discussion. So I think that's something to keep in mind. Another common things I would say in my interactions with many founders is that when they think about valuation, they tend to try to convince the investors, VCs, that says, if I am able to do this, I paint a big vision, therefore when they think about valuation, they use the end game as the anchor point to think about valuation, but that's not how we think about it, right? That end game, that vision is why I'm interested in having a conversation with you, in listening to your story, but that's not how I drive my valuation discussion with you. That's not the anchor point. The anchor point, because from here, from 0 to that 100, there's so many steps along the way. So that's something that I want to share with you, is that how investors think about it for an early stage company. When you think about valuation, don't use that as the way to argue with investors about valuation, because that's not how we think about things.
Well, you mentioned the macro environment. Obviously, the issue of valuations, people discuss on and off forever. But since last year, and the market was quite frothy last year, we've had a stock market crash in China, down rounds, several US tech companies. I mean, what's the state of play now? It seems from what you guys are saying, from Anna's experience earlier this year, there's still some companies that are demanding quite high prices. I mean, can you talk a little bit about where you see the market now?
Well, I think in Asia, in particular for us, it's Japan, Korea, and China, and somewhat, and also US. But the Asian deals, we internally call a flat round is the new up round. And I think flat rounds are increasingly more common. There's a lot of resistance from the entrepreneurs to go for a down round, obviously. But I think this is a very tough environment to get an up round, especially if the previous round was one of these high rounds. And down rounds are very peculiar beast, because once you have a down round, typically you would have to re-up the management team on their options. And it's actually fairly rare that the new investors can make money, because even if you sold it at the prior round price, the management will make a decent amount of money because of the re-ups. So historically, VCs also don't like down rounds. Now, I think there are some young VCs or young firms that might jump to the fact that, they could do a Series C at Series B price. And that seems very attractive, but historically, statistically, those deals actually don't do too well. So I think it's it's going to be a conundrum in Asia the next couple of years.
And I mean, can you talk a bit about your experience with this company earlier?
So I think it hits the early stage last. So it's going to hit the Ps first and hit us last. And for us, we haven't had any down rounds. We've had 2 companies do flat rounds this year. But I think it's been an excuse for some companies that were started a few years ago to actually close down. So I think, when the market got a little bit bad last year, we had, maybe 2 or 3 companies shut down, which is really healthy. I think companies, if they're not going anywhere, they should just shut down or pivot or do whatever. I think in reality, what happens is, there are a lot of new R&B funds in China. And so even though some of the US funds are a lot more cautious and slower, there's a lot of companies can still get money from these new R&B funds and government money. And those have a lot of closing risk. They don't always close, but it takes a long time. So at the early stage, we're still fine. And some of the valuations, I mean, this year, we keep expecting it to get bad, But for example, one of our SaaS companies, David and them just invested in, but they had 3 term sheets. And we have another company that got 8 term sheets last week.
Wow.
So I think if you're a good company, you're still getting, people still want you. And I think it's just, if you're not doing as well, then people are not buying the story as much. So I think later stage investors, they want to see a clear path to profitability. They want to see actual numbers. They're scrutinizing everything a little bit more.
As an investor, is it a concern to any of you guys, the fact that you have a stake in a company that has had a down round? I mean, how do you deal with that?
We have been, in the last 18 months, I haven't seen our portfolio companies having a down round, but certainly there are a couple of flat rounds. Usually, from an investor perspective, obviously we don't like the down round, but you got to do what you got to do, right? You, as the founder, you are running the company, and if you have a vision and you says, I'm on the right track, I need to accomplish what I set out to do, and if that's the only way that you can get money, then you have to do it. That's my advice to founders, right? And because you cannot get yourself stuck at a valuation issue and then not moving forward. I think both investors and the founders would have to just accept that perhaps the last round valuation, the pricing was wrong. And it's nothing to be shameful about of being wrong. Anybody could be wrong. I mean, last year, 2015, April 2015, when everything is so bubbly, right? the pricing may not be the right price. And so if now the price is resetting, it's more important to get funded and continue to do your business versus struggling on valuation and lose the window of opportunity.
And then, go ahead.
I also think that the reason why in Asia we're not seeing, like in the US, you start to see down rounds. In Asia, not as much. I think there's 2 reasons. So in the US, what happened was end of last year, you had companies like Pure Storage or Square that went public below the last private round. And once that happens, everybody starts to adjust because people realize that the private rounds are too expensive. In Asia, we haven't seen that kind of an exit yet. And once you start seeing them, then I think the market's going to adjust. But the flip side is, in Asia, the growth is growth is faster, and labor still is cheaper. So, I think there's still a lot of hope about growth that fuels the fact that, this is just a little bump in the road. But I think once you start seeing some Chinese company going public in the US or either Hong Kong or even domestically, those public comparables are really going to start setting the price for everybody. But it just really hasn't happened yet too much the last 6 months.
Is that an issue for you guys, Anna? Since you invest so early on in the process, you probably get the best valuation for the companies, right? When they aren't perhaps as frothy.
Yeah, I mean, we always get the lowest price for the companies, right? So in this type of market, it really affects us the least. I mean, even if my typical valuation, say, is 5 million, in a really strong market, maybe the average becomes 8 or 10 million, but at the end of the day, it's still 5 or 8, right? And then in a bad market, probably the 10 goes to 5 or below, and yeah, it doesn't really matter, but yeah.
In the past, a down round would be a really bad sign that companies were struggling. But is that the case now, or is it just about taking away a bit of the froth, as you guys were talking about earlier? David, do you want to take that? I mean, since you mentioned.
I don't think just because you go through a down round means the company is struggling. I mean, the company could be doing well, but the market comparables may be down, and therefore the way people prices changes. So, it really depends case by case.
I think the down and up, I go back to my earlier comment. I think the down is all relative, right? It's relative to last time. So if the last time's prices was already 2 times or 3 times of what it should be, then it shouldn't be there, right? So now the down maybe is the right price. As long as you can get funded, as long as you can get your business continue to make progress, forget about it down or up.
I mean, and as you mentioned, there haven't been, at least that I can recall, any, down rounds in Asia. Does that mean things here are better than in other parts of the world?
Well, I think what's interesting in Asia, there might not be in our portfolio, in Asia, there hasn't been down rounds. But what I'm seeing now, though, is, some O2O companies in China, for example, instead of going through a down round, the company is just shut down.
Or they merge.
Yeah, or they merge or they're shut down. And so, it's quite interesting phenomenon to see where both the management and the investors, in some cases, they'd rather just shut it down or do a fire sale instead of a down round.
What does it say about valuations when you get companies like Ant Financial, Lufax, or Didi that raise funds that constantly, hire multiples? Is all the money just flowing to the big companies, the champions in their sector?
Well, I think those companies, because of sheer size and their impact on the society, if you look at Didi, if you look at Ant Financials, I do think they are valued a lot, right? If you think about how they change the world, change your life. But the headlines always capture those. I think I'm sure for Anna and for David, for us, we continue to invest in small companies, early stage companies. It maybe used to be $8 million, now maybe it's $5 million or $6 million, but there's still tons of companies get funded. I think even in such an environment that people are saying, maybe it's a winter time, but good companies still get funded. So I think, I don't think the money are only chasing the big ones. There are still plenty of funding going into those young startup companies with a ambitious founder, very capable to assemble a team and doing something great.
But isn't it a concern for you guys as an investor, that these smaller companies are fighting these massive behemoths that are quite well funded? I mean, how do you analyze when you have a young entrepreneur with a small company that's trying to, offer something similar to what Ant Financial is doing, for example?
Finding that niche, finding that white space that's a founder's job.
And that's also the VC's job, I think, to, if it's easier for Tencent to do something, maybe we wouldn't fund something like that. But yeah.
As an investor, are you guys more careful now? Given what's happening with valuations, down rounds, stock market performance. How are you guys going about analyzing and assessing companies ahead of investing?
In a way, for us, nothing has changed much because entrepreneurs, and I'm sure many of you guys are entrepreneurs, they don't really wait for the market. I think maybe 10% or 20% are more opportunistic, but most of the time, if you have an idea and you want to pursue entrepreneurship, you don't really care what the market situation is. You're just ready to get going, and it's a long-term game. It's not like, it's really like a 10-year game. It's not short 2 or 3 year cycle. And the other thing is a lot of VC funds have raised a lot of money recently in the past few years, so everyone has plenty of cash to spend for good companies.
Mm-hmm. How about for you guys, David and Xing?
I think we're definitely more careful, but I think it's a function of the fact that we've done many deals the last couple years, and you realize that many of these companies now, instead of doing only 2 or 3 rounds before going public or being bought, might have to do 4 rounds, 5 rounds. So it's going to take a little bit more effort, and we'll have to spend more time on the harvesting side. They need more help, and so it takes more of our bandwidth away. So from that perspective, I do think that with new deals, we're much more careful about valuation. We're much more careful about making sure that the due diligence is done thoroughly. I think last couple years, there was almost this frenzy where it was okay to do a deal in 5 days because, everybody was competing. And today, even though people are competing, nobody is going to quickly get a deal done because they want to make sure they're right. Because the cost of getting it wrong is getting much higher today.
What's
Yeah,
your
we
vision?
are still as busy as we always been, right? We're still very active out there, engaging with founders, talking to startup companies, trying to understand and learn about what are the new models, new technology out there. So from a work perspective, actually, it doesn't really change, as Hannah said, whether the cycle is up or whether the cycle is down. But from an investment decision perspective, like very much like David had described, we will be a little bit more cautious. You know, part of it is because we are also very busy working with our portfolio companies that we invested in the last few years, right? So that's the dynamics. I think actually at least in China, I don't think right now the environment is so, the valuation has come down so much that every company is going through a down round psychology or discussion. Actually, I think the valuation has rationalized a little bit, but there are certain pockets I see still valuations are very high.
So what do you guys think would take for them to become more realistic? I mean, you know, what sort of thing has to happen to be a better business for you guys as investors? I mean, what would it take?
It takes some more time.
Or maybe
Takes
some
some more
companies
time.
going bust or something like that?
If you look at the O2O space, certainly there have been many companies that has stopped the business, right? Just shut down, which may be the right thing to do, like Anna mentioned earlier, right? Certain companies, as a founder, I think it's also very important to know when to stop and say, this is the wrong way to go. I just need to stop it.
And as an investor, are there any kind of companies or sectors or even countries in Asia that are doing better than others that, you know, might be immune to, you know, the down cycle in valuations? I mean, where are you guys more optimistic?
Well, there's some ridiculous valuations in the live broadcasting, live streaming space in the mobile sector. And I still see a lot of e-commerce companies. And certainly in AI, VR, a lot of companies there.
How about you, Xing?
We have been continue to be very active in looking at enterprise area, you know, SaaS, cloud computing, big data, right? Data analytics, the to-be focused kind of a technology helping companies do better. On the consumer internet side, I think in how internet changes people's education, learning, how internet changes people's healthcare, how internet changes your offline, your usual lifestyles, right? Sports or cultural entertainment. All those areas are still quite attractive to us. I think we are still looking at founders that can come up with a creative product or a business model, innovative business model, or innovative technology to change that.
David, you guys obviously invest globally, not just in Asia. I mean, any countries that now, or regions in the world that are more attractive or better for investing?
Well, I still think long term, you know, China is still very attractive. So I think this is just a fairly small bump in the road. I do think that kind of the whole slowdown, you see less of a slowdown in places like Japan, even Korea. So, you know, I think the sectors that Anna and Xing talked about are the sectors that will continue to get a lot of interest. And I think it's very good because, you know, when the bubble popped in 2000, right, both telecom, internet, and Y2K, and then everybody was in shock, you know, people kind of didn't know what would be next. But I think today it's a little bit different because mobile still has momentum, even though penetration is slowing down. But you see, you know, whether it's VR, AI, drones, B2B SaaS, you know, those areas continue to grow, and there are new platforms coming out. So I think, you know, we're still excited, and I think a lot of our, you know, peers in the VC are still excited.
It used to be, you know, that Chinese companies would flock to the U.S. markets, looking for the seal of approval of U.S. investors and also the better valuations they would get there. But now that trend has kind of reversed with many companies either delisting from the U.S. or simply just saying we want to go list in mainland China because valuations there are so much higher. How do you see this playing out medium to longer term? Both the trend of delisting or companies just simply, looking at the higher valuation and going to list in the A-share market in China.
Well, the biggest conundrum that startups face today is the arbitrage between the domestic Chinese market PE ratio, which if you're a gaming company or a mobile company, you're talking about 60, 80, 100 PE, right? And in the US, you go public on NASDAQ or New York Stock Exchange, you're lucky if you get 20. And I think that's causing all that, whether it's delisting or people trying to go public in different places. I think, we all know through our finance classes that an 80 PE is not sustainable. So sooner or later, I think things will even out. And it's also a bet because even if you try to go public in China today, the line is pretty long. And so, for example, all three of us, one of our companies called 51 Talk filed, to go public in the US. And it was a very calculated bet because we could actually go public quicker in the US than China, even though China offers probably a higher multiple. But for this company, we thought for them to get capital now through the public market is a much better path. And so I think those are the kinds of, strategic decisions that are happening. And it's a very interesting time.
We're out of time now. Thank you very much, everyone, for listening in, and hope you're still awake out there after lunch.
Thank you.
Thanks, David, Anna, and Xing.